Okay, g'day. This is Rudy from Rudy's Growth-Based ETFs. So today's video is about the difference between the balanced and the growth option of your super fund. So at a high level, your balance is 65% in growth and your growth is 80% in growth. And the other part are the other defensive assets, so 35% defensive and 20% defensive. So you can see there, so the growth has got less defensive and more growth. And when we talk about growth, we're talking about Australian shares, international shares, property and infrastructure. Infrastructure is when they go and buy a building, big property office or something like that. And you can see you've got more, essentially in growth you've got more shares than the balanced option. So now to put that into a picture, I like to use charts. That's my game. So what we're looking at here is so your super fund, the international part that makes up your balanced and growth fund, invests in this. So your super fund, high growth, this is its return. So you can see since 2021, you've had very good returns. Nothing to complain about. But my view is I believe the international share market's going to come in for a correction. But anyway, that's another video if you're interested in that. But you can see here the same here. So back in May 20 to January 22, it had a good run, and that's because of the high exposure to the share market, obviously, because you know the share markets go up and down. But you can see there's essentially, in the long run, it's sort of going up, but there's big swings, which you can avoid, and that's all about in another video. But anyway, so that's your high growth option, and that's how it will move in your super fund. So you'll see some years which are stellar and some years which are average. Now, if you're in a balanced option, this is how your balanced option has performed over time. So again, the last couple of years you would have been happy. Look at that, it's going up. So this is a combination of all the international shares and these Aussie shares and the property that are doing all this, which we'll show later. But you can see on average it's, it doesn't have an upward trend to it. It just goes up and down, which is why they call it a balanced fund, the safer fund. But it doesn't really grow. So if you're going to be, my philosophy is if you're under 55, you should just be in a growth fund. Or especially if you're in your 20s, 30s, 40s, it's because it's going to grow more than a balanced fund. But I do believe, and that's in other videos I do, that you can time these things and switch out. So for example, right now, I'd be switching out of your growth option into Rudy's growth option, which I use ETFs, which you can do in your super fund. So for example, I'd be buying gold at the moment, which you can do in your super fund. But that's for another video. I'm just trying to teach you balanced and growth. So this is how your super funds work. So underlying that, so this is the international share component of your super fund, i.e. the balanced and the growth. So this feeds into those balanced and growth returns. So that's international shares. So obviously in growth you've got more exposure to international shares, so your returns have been higher. And this is the Australian shares. So you can see the Australian shares, they're still going up. That was the COVID dip, still going up. So they've not as much up as the international shares, And again, I believe we're in for a correction. So I think this year your high growth and balanced funds will actually might be close to zero or negative returns. But that's another option. That's another video. And the other component, property, is a big one of the. So we had international shares, Aussie shares, and property that make up the three asset classes in your balanced and growth. And you can see property, well, it's sort of has its booms and busts, but it goes sideways. There's not like shares, which has that trending up. So there's no mystery behind. So when you invest your money in super, it's not really them doing anything. It just depends on what option you tick. So if you tick balanced, then that's what you're going to get, and that's a result of the exposure to international, Australian, and property. And if you tick high growth, which most people don't, because the default's balanced, if you tick the high growth option, then this is what you get. So that's under the bonnet with your balanced and growth fund. So as I said, if you're under 55, you should always be in a growth fund, but you should really be in Rudy's growth fund, where I use ETFs that you can use in your super to avoid these things. So that's because the secret to it, I'll just let you into a quick little secret. So everything, they always form an upward channel and then they break it. And once it breaks that channel, it goes down. So what do? You wait for it to break the downward channel. So basically you get out of here. So, well, there's two smart ways of doing it. You'd switch your high growth to cash here, and you just sit it pretty, and you'd wait a year or so, and then once it goes up, okay, you switch to high growth. So you saved yourself, nearly, depends on where like if you got in here and you didn't get out, well, you're back to square one almost. So whereas if you sold there and then got in here and wrote it up, you'd be doing very well. But if you were to switch to Rudy's growth option at this stage, you would have kept going up, because I invest in assets like gold and healthcare and consumer discretionary ETFs, which go up when markets go down. It sounds a bit strange, but yeah, when the share market goes down, not every share goes up. Anyway, the objective was to teach you about balanced and growth funds. I hope you enjoyed it. Drop a comment, subscribe to my channel for more information. See ya.